Welcome to Volatility Trading Strategies. In this video, I'll give a more detailed explanation of our VTS Iron Condor strategy. It is a derivative strategy, but it's actually very easy to follow, and it captures profit from a very specific market environment. So first of all, if you haven't had a chance to watch the videos for the other two strategies we have here, I'll put up some links and you can watch those ones later. But right now, this video is all about Iron Condors, so let's get into it. Why should we trade derivatives at all? So I view derivatives as an asset class in itself. Now, of course, the term derivatives does cover a huge market, and there's many different forms that it takes, and of course, countless different ways to go about trading them. If you're not aware of how big the derivatives market actually is, you can check out this video here. Most people, when they watch this video, they're quite surprised by the scale. And spoiler alert, it is actually larger than all the world's stock markets and all the global bond markets combined. So derivatives, of course, is a very broad term. But I'm a huge proponent of diversification and trading across as many asset classes and investment strategies as possible. Our total portfolio solution, it already covers stocks, bonds, gold, volatility ETFs, so adding in some derivatives exposure further diversifies and improves the portfolio. So this is a chart of the Russell 2000 index with today's price right there at 1372. Now we can say a lot about how we got here and what caused it, but what we don't know is where we're going next. Anybody who says they know, of course, is just fooling themselves. You can draw a little price line here. 2 months from now, we really don't know where we're going to be. Will we be above this line? Will markets crash and go well below this line? Nobody really knows. But we do know that there's a 68% probability that we'll be within one standard deviation up or down from today's price. And we know there's a 95% probability that we'll be within 2 standard deviations, up or down, from today's price. This goes back to all those very boring statistics classes that we all took. I was actually one of the weird ones that went on to study math and statistics in university, but for most people, they really did hate those old stats classes. But even if you did hate them, you probably still remember the standard Bell distribution. Future occurrences tend to gravitate towards that mean, and we have increasingly less probability of seeing values further away from this mean. If we flip this on its side, we can apply it to my trading example. Imagine this bell curve with the mean centered right on this price line. That's today's price of 1372 on the Russell 2000. Now, without knowing what future prices will be, the odds are much higher that it'll be somewhere near this mean, rather than prices further away from it. Now, of course, we might see a crash well below it, or maybe just a nice rally that takes us way above it. But most likely it will be closer to this mean. And that's exactly what we see in the markets in the real world. We are, of course, emotional creatures, and naturally we fear those big crashes. And of course we hope to be there for the big price increases, to ride those rallies as high as we can. But in reality, markets spend the vast majority of their time just chopping around this center line, not really making any major moves in either direction, at least in the short term. We're talking about 1 to 2 months from now. So the VTS Iron Condor strategy doesn't actually have to make any market predictions. We don't have to know whether markets are going to go up or down. We just have to understand probability theory and design a strategy that effectively exploits that. So now let's get into the question of what is an Iron Condor. So what you're looking at here is your typical Iron Condor option spread. This is today's price right there, that little gray hash mark, 1372 on the Russell 2000. And all of this here, this is our profit range. Above our strike price and below our strike price, that's where the losses occur, right there and then over there. Now, we don't actually hold our positions open until option expiry, but as long as the price stays somewhere in this range, closer to that center line, we will be profitable. Now, of course, there are times that it doesn't, and that's when risk management and stop losses, for example, come into play. But like I said, most of the time the markets are pretty uneventful, and in the short run we just capture that easy profit in this middle range. It is also important to note, though, that while Iron Condors that may have already been open, if there's a market crash and you have a trade that's already open, it's very likely that that trade will hit its stop loss and you'll take some losses. But if you open new Iron Condors during times of extreme volatility, say immediately following a market crash, they can actually do very well because the premiums that you're bringing in for the trade actually extend these strike prices quite wide. So you can cover a very wide range of future prices. So, the Iron Condors, of course, they can lose money. All trading strategies can. They suffer drawdowns from time to time. But Iron Condors are great because they can recover losses quite quickly. sometimes a lot more quickly than other trading strategies can. So if we want to view this trade into that original chart, we've got strike prices of 1500 and 1250. On that chart, it's going to look something like this. So hopefully now you can start to see why the Iron Condor is such a powerful option spread. Because if we do want to capture that profit and have the highest probability of being successful going forward, into the unknown of course, because we don't know where we're going to be 2 months from now, we need to cover as much of this area as possible, because that's where probability theory tells us that future prices are most likely going to be centered. And that's exactly what the Iron Condor is designed to do. A very common question: what level of performance is realistic? A realistic target going forward is about 1 to 2% a month on average in the long run, or about 12 to 24% annualized. And this really gets to the heart of why I feel so many Iron Condor traders out there, and option traders in general, lose money in the long run. They overextend their strategies and they chase returns that aren't realistic over multi-year time horizons. The problem with Iron Condor trading is that it is very possible to make large monthly returns for several months in a row. But when people chase high returns, inevitably they tend to give massive chunks of those returns back when the markets don't cooperate. It's very common to see Iron Condor traders make 5 or 10% a month for maybe 6 or 8 months straight, only to give 30 or 40% of it back in a single bad month. And if you go on YouTube or you just Google Iron Condor trading, you'll see dozens of so-called trading gurus talking about how easy it is to make big monthly profits. They don't tend to mention those drawdowns that they suffer. To hear them tell it, trading Iron Condors is just printing money, which is absurd, of course. Eventually, there will be consequences to chasing those big gains. My trading philosophy is all about risk management and smoothing out long-term performance to help people achieve the safest and most consistent returns available across their entire net worth. We don't chase unrealistic performance, and we're very quick to adhere to those stop losses because managing the drawdowns is far more important than going for those big monthly gains. The VTS Iron Condor strategy currently makes up 25% of the total portfolio solution, and it's achieved consistent results on its own, but more importantly, it's uncorrelated to the other 2 strategies in the portfolio, which makes it an excellent complement to our long-term diversified portfolio. So now let's talk about the account requirements, because of course this is derivative trading, and there are a few compliance issues that I want to talk about. So the first thing people should be aware of is it's currently not possible to trade Iron Condors within tax-sheltered accounts. Now I'm hopeful that laws will change in the future, and we're already starting to see a few brokerage houses that are becoming more open to this, but as of now, you should just make plans to make these trades in a regular brokerage account outside of those tax-sheltered accounts. And the second issue is you'll need a higher level of options trading approval. Now I don't know why they do this, because Iron Condors themselves are defined risk trades, but right now they are at the highest option approval level, so you're going to have to get that. And I can't tell you to just tell your broker that you have option trading experience so that you get approved, but what I could recommend is that you can contact them and let them know that your signals are coming from an experienced subscription newsletter, and hopefully that'll be enough to get you approved for the trading. But I'm certainly not going anywhere, and neither is this strategy. It is designed for multiple decades of trading, so there's no urgency here. If you have any questions at all, you can email me, and we can work together to get things set up for you so you can make these trades. I've been successfully trading Iron Condors for many years now, and I invite all of you to consider the benefits of adding some derivative trading to your long-term portfolios. Now you can sign up for the VTS newsletter here. You'll get all the latest articles and videos. Some of these will be talking about Iron Condors specifically, so you can increase your knowledge of option trading there. And lastly, on the website, I do offer free 2-week trials for all of our trading strategies, so you can try any one of them out risk-free before making any decisions. So thank you very much for watching, and I will see you next time.